At 22, Sarah quit her soul crushing job with $4 in her bank account and a radical plan to retire by 30. Most experts call her path reckless, but her specific strategy of aggressive tax advantage compounding turned that $4 into an annual five-figure passive income stream. I'm going to show you the exact math behind her exit, the specific assets she chose, and the one consistent habit that separates those who retire early from those who never leave. Time equals 500 M's. So grab a cup of coffee, settle in, and let's get into the weeds of the simple path to wealth. Most people think wealth is about picking the right stock or finding a secret investment that explodes overnight. They spend hours every week staring at charts, reading news feeds, and worrying about the next recession. But J.L. Collins, the author behind the movement, argues that this behavior is exactly what keeps you poor. He says the complexity is just noise designed to sell you products and services you don't need. When you strip away the jargon and the fear-mongering from Wall Street, you are left with something surprisingly simple. It requires patience, discipline, and a complete lack of interest in winning the game. You are not playing to beat the market, you are playing to join the market. And that brings us to the first step. The first win isn't about how much you make, it's about how much you keep. This is your savings rate. If you earn $100,000 but spend $99,000, you are effectively running on a treadmill that never stops. You need to widen the gap between your income and your expenses. J.L. Collins often highlights the story of people living on half their income, not because they are miserable, but because they have realized that spending money on stuff does not lead to happiness. Data from the Bureau of Labor Statistics consistently shows that the average savings rate for most households hovers in the single digits, which is why retirement feels like a dream that is perpetually moving further away. When you bump that rate to 25 or even 50%, you aren't just saving money. You are buying your freedom. Each dollar you save is a little employee you send out to work for you. By the end of the year, those employees have hired more employees, and soon you have an army. It's a beautiful system once you see it in action. But knowing you need to save is easy. The real challenge is where to put that money so it grows without you having to be a professional trader. This leads us to our second point, the power of the broad market index fund. Think about the stock market like a massive, constantly evolving business. Some companies fail, some stagnate, and some grow to become global behemoths. If you try to pick the winners yourself, you are fighting against the odds. You are betting against professionals who have supercomputers and teams of analysts working around the clock. Instead of picking individual stocks, you should buy the whole haystack. When you buy a total stock market index fund, like the VTSCX offered by Vanguard, you are effectively buying a tiny slice of thousands of companies. You own the winners, you own the losers, and you own everything in between. Since the inception of the S&P 500 index, it has returned an average of roughly 10% annually over the long term. This isn't just a random guess. It's a historical reality that has persisted despite wars, financial crises, and political upheaval. When you put your money into a low-cost, broad market index fund, you stop worrying about the latest news cycle. You stop asking, is now a good time to buy? Because you realize that for a long-term investor, every day is a good day to buy. By avoiding high management fees, which can eat up 20, 30, or 40% of your potential returns over a lifetime, you keep the vast majority of the growth. It's boring. It's unexciting, and it's arguably the most effective wealth building machine ever created. If you're finding this perspective helpful, hit subscribe. I break down complex financial philosophies like this every single week. Sticking around for the final point is worth your while because it's the one thing that separates the people who talk about wealth from those who actually retire early. Okay, so we've covered saving a high percentage of your income and putting it into broad, low cost index funds. That's the foundation. But here is the secret sauce: the ability to ignore the market entirely. This is the psychological mastery that J.L. Collins talks about most passionately. We are hardwired to panic when things go wrong. When the market drops 20% a single month, your biology is screaming at you to run. It's the same fight or flight response your ancestors used when they were being hunted by predators. But in the stock market, flight is the most expensive mistake you can make. Consider the market crash of 2008. The S&P 500 fell nearly 50% from its peak. People who sold in a panic during that time missed out on the historic recovery that followed. Those who simply stayed the course, who kept buying their index funds every single month, regardless of the red numbers on their screens, saw their portfolios double, triple, and quadruple in the years that followed. Staying the course is the hardest thing you will ever do. It requires an almost robotic level of detachment. You must view market volatility not as a threat, but as a feature of the system. You have to learn to love market crashes because they are essentially stocks going on sale. That is the shift. When you have this mindset, the market stops being a place of stress and becomes a place of opportunity. You aren't watching for the bottom. You are just consistently feeding your account. You aren't guessing the future. You are betting on the long term human drive for progress and profit. Think about the math here. If you invest $10,000 a year into a fund returning 10% in 30 years, you have over $1.8 million. dollars. And this happens without you spending a single minute analyzing spreadsheets or listening to talking heads on financial news networks. It is the ultimate expression of set it and forget it. Once you see it this way, you can't unsee it. You realize that you have been sold a lie that wealth requires complexity and constant monitoring. You see that your freedom was available all along, hidden behind a mountain of unnecessary financial noise. The path is simple, but it is not easy. It requires you to look at your bank account, choose a lifestyle that costs less than you make, and buy an index fund month after month for decades. That is it. No secret formulas, no insider tips, just the relentless, quiet application of these three steps. So there you go. Three actionable steps to building true wealth. And the most important one is simply staying the course when everyone else is running for the exit. If you got value from this, please share it with someone who is currently overcomplicating their financial life. Subscribe to the channel so you don't miss the next deep dive into the strategies that actually move the needle. Stick around because next week I'm breaking down the specific tools you need to automate this entire process so you don't even have to think about it. I'll see you there.